Hello and welcome back. So we are still looking at banana part 2. So third number question that we need to solve is about how the gain or loss on disposal of strawberry should be recorded in the consolidated financial statement, and how the investment in strawberries should be accounted for after the part disposal. Okay, so how we should be accounted for, we should talk about that, and then disposal as well, right? Okay. Disposal and further treatment. So how much did they dispose? So disposed of 75% of the 40, right? So how much will that be? 75 of that 40, right? So equals to 70 or 0.75. 0.75 into 40, right? So that will be 30. So 75% of its 30th on 1st October 20x6 for 19 million, when the fair value of the net assets of strawberry were 50 million, right? 19 million. So at the date, Banana lost his right to appoint one director, and then the fair value of the remaining 10%. Okay, so it was 40%, out of which 30% is sold, which is 75%. So that is sold, and then the equity interest was 4.5 million at disposal, but only 4 million at 30th June 20x7. Okay, so it was 4.5 at disposal date, right? Banana recorded a loss in reserves of 14 million. How can they do that, man? Calculated as a difference between the price paid of 18 and then 4. That's not the right treatment. Banana has stated that they have no intention to sell their remaining shares in Strawberry and wish to classify the remaining as fair value through OCI. Okay, so let's talk about that as well. So first of all, let's talk about disposal. On disposal of 75%, right? 75% the shares, Banana can no longer exercise no longer exercise significant influence over significant influence over Strawberry. And then after that, what we need to do is that how much profit should be recorded? Isn't that the question? So gain or loss on disposal. Let's calculate that first of all. So what do we need to do is that we need to calculate gain or loss, right? So proceeds and then after that carrying amount of investment. Fair value of retained interest. So in this case, even though the retained interest has only been revalued at the end, but if it is like, suppose this interest was less than its previous amount, then what we need to do is that we need to basically uh, recognize a gain on revaluation immediately. Okay, so since it is a sell, so how much did we sell it for? 19 million, right? So 19, and then after that retained interest is 4.5. Okay, so and then what's our net assets? So how much was it? I think we calculated it over here. So 20.4 is our investment in associate, right? 20.4. So which is this figure plus this figure minus this figure, right? Gain on disposal. Okay. So what I'll do is that I'll just copy this everything. Calculation of gain on disposal. So that's done. So what does the question ask? How the investment in strawberry should be accounted for. But we need to talk about this thing as well, right? Loss in reserves has recorded a loss in reserves of $14 million, which is incorrect and should be reversed along with recognition of $3.1 million as gain in consolidated statement of profit or loss. So that what do we need to talk about? So the remaining 10%, as per IFRS 9, financial instrument is a financial asset, right? So as per IFRS 9, it is a financial asset, I guess. No, I guess. Can we? Did the question asks about that? So should be accounted for how the investment in strawberries should be accounted for. Okay. So as per IFRS 9, remaining interest, that is 10%. 10%, right? 10% be treated as TREAT, treated as should be treated as financial asset. It since the entity's business model is to what it says, fair value through OCI, right? He has no intention to sell. Is not to trade in short term, but rather hold it for longer period, long run. It is treated as fair value through OCI. And something else. So fair value through OCI, any gains or losses is charged in OCI. In this particular case, initially it is recorded at fair value, that is 4 million, 4.5 million. Initially recorded at fair value, that is 4.5 million, and subsequently the value has dropped to 4 million. So 0.5 million is reported as loss in other comprehensive income. Anything else did we miss? I don't think so. So B, uh, it as an asset acquisition. What does the IFRS proposed amendments? So exposure draft as well. P number, right? So in case of Melon, so even I'm not really aware about this particular exposure draft. So we will look at the model answer for this. So on 30th June 2007, Banana acquired all the shares of Melon, an entity which operates in biotech industry. Melon was only formed and its assets consists of license to carry out research activities. Melon has no employees as research activities were outsourced, right? So the activities are still at very early stage and it is not clear that any definitive product would result from the activities. A management company provides personnel for Melon to supply supervisory activities and administrative functions. Banana believes that Melon does not constitute a business in accordance with IFRS 3 business combination since it does not have employees nor carries out any of its own processes. Banana intends to employ its own staff to operate Melon rather than to continue to use the service of management company. The directors of Banana therefore believe that Melon should be treated as an asset acquisition but are uncertain to whether IASB's exposure draft definition of business and accounting for previously held interest would revise this conclusion. Okay. Banana should treat Melon as asset acquisition if it fails to meet the definition of business under IFRS FRS 3 business combination. As per business combination, as per IFRS 3, business as an integrated set of activities and assets that are capable of being conducted and managed for the purpose of providing a return in form of, I'm writing a standard definition for this, form of, so it's basically what it means is that there should be some activities and then there should be some uh, it should be conducted and managed so that it provides a return. Okay, so there should be two things. That's what it basically means, but I'm just writing the standard definition. Dividends, lower costs, or other economic benefits directly to investors to investors. Okay, so what this particularly we need to talk about is that a business typically a business will typically have inputs and processes applied to create outputs. Outputs are the result of inputs and processes and are usually within a business but are not a necessary requirement for a set of integrated activities and assets to be defined as business at acquisition. So even though if it's not providing any output, it doesn't really matter. So Melon has both. So in this case, let's look at it. So what are its inputs? Basically, first thing first is its license, right? And then it does not have any employees or anything. Melon has license as an input, which it controls and is capable of producing outputs once one or more processes are applied to it. Okay, and then after that, so what has Melon been doing? Outsourced to other companies, right? No employees. Activities are still at early stage. It's not clear that definitive product would result. The seller does not have to be operating the activities as business for the acquisition to be classified as a business. All right. And then after that, since Melon does not have staff but sources its activities, right? So an outsider does the job. So the definition of business requires just that the activities could have been rated as a business. Processes are in place through research activities, integration of management company, and supervisory and administrative functions performed right. So they are planning to but it plans to, right? Plans or intents, right? Since the processes are in place and the outputs has not been any, but it is not compulsory to have an output. To have output, so it meets. So it can be treated as business because it's not compulsory, and then the processes are already in place for operating it, right? treated as business. Okay, so that's done. Exposure draft. Let's talk about that. Doesn't that what question asks us? Exposure draft, right? Exposure draft. So I'm writing the standard answer for this because even I had not looked at this exposure draft of this. So I would resort to standard answer. Okay, the board has given clarity to the definition and an exposure draft has been issued. It proposes that no business acquisition has occurred if substantially all the fair value of the gross assets acquired is concentrated in a single assets or group of similar assets. So this is the exposure draft. Okay, so if the fair value of the gross assets is if it is concentrated within single assets or group of similar assets, then it is not a business combination. Okay, a business acquisition. Okay, so in our case, right, in our case, so we need to, so this is our exposure draft. So if this comes into effect, how would that affect our this particular question, right? So in this particular question, so we have acquired it, and then its main thing is its thingy, right? License to carry out research activities. Okay, so we don't know that value, right? So research activities here be at very early stage and whilst in substance are very different in nature to license itself so it's likely to be it's likely to be relatively relatively low value. And if it is to be assumed that substantially all of the fair value is concentrated in the license itself, then the acquisition would not be treated as a business combination. Okay, so it would not be treated as a business combination. But if research activities constituted as substantial part, then it would meet be treated as business combination. So therefore further information if exact values of research and license were to be given, then this determination would have been safe. Okay, having said that, so if it's we just need to look at whether the substantial value has been concentrated in single assets or not. Okay, if it is concentrated within single group of assets, it's not a business acquisition. If it is, then it is not, and then if it is not, then it is a business. Okay, and then after that, let's look at question number, did we finish everything? So propose amendments, everything. Okay, that's done. So C number, right? So derecognition requirements of IFRS 9 should be applied to the sale of bond, including calculations to show the impact on consolidated financial statements for the year ended 30th June 2007. 7 marks, 7 marks, right? So derecognition requirements of IFRS 9. Let's talk about that. C. Okay. So in case of bonds, right? Or is it not about bonds? Derecognition. What does it say? And should be applied to bond, including calculations to show the impact on consolidated financial statement. Okay. So we need to show calculations as well. So bonds derecognition. Just bold it as well. IFRS 9. IFRS 9 financial instruments states that a financial asset can only be derecognized when the contractual rights to receive the cash flow when the contractual rights to receive the cash flow from the asset or where the entity has retained the contractual rights but has an unavoidable obligation to pass on the cash flow to third party. Third party, right? Risks and rewards of ownership should also be taken into account. Right. So in this case, what has happened is that Banana acquired 10 million shares, right? So this date, that's the contractual cash flow arising from bonds and measured at amortized cost. Okay, that's not a big deal. But after 1 year, Banana sold the bonds to third party for 8 million. The fair value of the bonds was this much. Banana has right to repurchase. Okay, purchase right option. So it's likely to exercise that option. The third party is obliged to return the coupon interest to Banana. Okay, to pay additional cash to Banana should bonds values rise. Okay, Banana will also compensate the third party for any devaluation of the bonds. So it has the right to repurchase the. Where did I see that? The third party is obliged to return coupon interest to Banana. Okay, so that means that has not been transferred. Okay, Banana has not transferred contractual rights to receive the cash flows from the bond, and the third party is obliged to return the coupon interest, right? And DREST, isn't that what it says over here? Obliged to return the coupon interest to Banana, right? And to pay and to pay and to pay additional cash to Banana should the bonds rise. Banana is the price rises, right? Banana still has the rights associated with the interest and from benefits from uh, upward valuation of bond, right? Also has the risk of over here, so we'll have to compensate for any devaluation. Third party, right? It also has the risks of compensation for any devaluation of the bonds. All right. So 8 million, right? The fair value was 10.5. Price, even the price does not reflect it, the standalone selling price kind of thing. The price, or what I can say is that the fair value bonds first July 20x6 on 1st July 20x6 is much higher than the sales price. So if the third party was to purchase this bond from other seller, would be sold at a standalone selling price of 10.5 million, right? 10.5 million. Standalone selling price of 10.5 million. $10.5 million, right? So the price also reflects that risk and reward of ownership is still with Banana. So would not be derecognized because risk and reward has not been transferred. Okay, and there is still option to repurchase Banana, and there is still option to repurchase, which is likely to be exercised so it would not be derecognized, right? So what we need to do is that let's create a table for that bond. Okay, so opening balance, give interest rate, give INT, interest received, closing balance. So what was the opening balance? So 10 million, right? 10 million, 5%, right? 10 million, 5% at 30th June each year. Okay. So 10, and then after that, what's the effective rate of interest? 7 and 5, right? So 7 and 5. Okay. Same thing for this. Is equals to 7. So what I'll do is that percentage. So 7 and then 5. Right. So this will be this percentage into this, right? And then after that, this will be this figure into this figure, right? This will be this plus this minus this. 10.2 will be our closing balance, right? So what about next year? What does it say about calculations? So applied to sell upon including calculations to show the impact on consolidated statements for the year ended 30th June 20x7. So just for 1 year, right? So for the next year, it will be, this year will be that, and then same as basically this into this, and then this into not this, for this it's this value into, because it's always on nominal value, right? So this will be copy paste. So 10.4, right? And then this is for from this period to this period. Okay, so after it has, so after it was sold, okay, after it has sold, and then after that, after 1 year, okay, after it has sold it to third party, and then after that, after 1 year, okay. So during this period, what we will need to do is that we will need to third party for 8 million, that will be regarded as, or that will be our financial liability, okay. Okay, so this will be our calculation, right? So I'll just add it up quickly. The bond is measured at amortized cost, because the entity's business model is to collect contractual cash flow over the life of assets, over the life of assets, right? And then even though when it is sold, contractual cash flows, cash flow rights is still retained. Okay, and then after that calculation is the carrying amount at 1st June, right? 20x7 would have been this figure. Right, would have been $10.2 million. And at $10.4 at 30th June 20x8. Okay, the cash received from sale, the proceeds received from sale should be treated as loan or financial liability. You could say that should be treated as loan, measured at amortized cost. The difference between the sale and repurchase would be the interest charge. That is 0.8 million, right? 0.8 million. Okay. So 0.8 million. Anything else that we missed? I think we've covered everything. That's all. So basically all we need to remember is that whether the risks and rewards of ownership has been transferred or not. That's the most important thing. And then we need to always remember that what's the business model, and then based on that we can use the amortized cost table, or otherwise classify it as fair value through OCI or something else. Okay, so that's it for today, guys. It's been quite long, this particular session as well. So we finished second question as well. We'll move on to third question after this, and hopefully we'll start getting few more ideas about SPR's exams. So until next time, bye bye.